Today, we're looking at how companies expand beyond their current markets to grow, diversify, and strengthen their position. This could mean entering a new country, reaching a different group of customers, or launching a new product category. These moves come with big decisions and risks, so having a clear, organized approach is really important to avoid losses or setbacks. A market entry strategy framework helps businesses do just that by providing a step-by-step way to evaluate opportunities, understand risks, and choose the best way to enter a new market. It combines market research, company strengths, regulatory rules, competition, and strategic goals into a single plan. Throughout this session, we'll explore how to apply this framework, look at examples, and consider its benefits and challenges, so you can see how it works in today's fast-changing business world. Market entry strategy is essentially the planned way a company brings its products, services, or operations into a new area, whether that means a new country, a different customer group, or a higher-end market segment. A comprehensive market entry framework helps businesses address key strategic questions like whether the target market is attractive and sustainable, if the company has the necessary capabilities to compete, which entry mode best balances risk and value, and the pace at which the firm should enter. Using this framework moves decision-making away from gut feelings toward a more analytical approach, which increases the chances of success. The practical benefits of such a framework are clear across different industries and company sizes. First, it helps identify and mitigate risks early by focusing on uncertainties such as customer behavior, regulations, competitors, and costs. Second, it supports efficient resource allocation by ensuring investments go to markets that align with the firm's strengths, reducing wasted effort and capital. Third, it promotes strategic consistency by making sure market entry decisions fit with the company's long-term vision, brand, and core skills. Finally, by carefully evaluating these factors, businesses can gain a competitive edge and position themselves better for success as they enter new markets. Organizations that consistently analyze competitors and the overall industry structure are in a stronger position to create unique offerings and establish market positions that can be defended over time. Having clear criteria and methods also helps improve transparency in decision-making, which builds agreement within the organization and makes it easier to communicate with key stakeholders like boards, investors, and partners. When it comes to developing a market entry strategy, it usually involves 6 linked stages. The first stage is market attractiveness analysis, where we assess whether the target market offers enough opportunity to justify entering. This involves looking at factors such as the market size and growth, customer needs and purchasing power, industry profitability, relevant technological trends, and the political, economic, legal, and regulatory environment. We use tools like PESEL analysis, market sizing models, and industry lifecycle analysis to get a clear picture. The second stage is competitive landscape assessment, which focuses on understanding the competitors in the market and evaluating how feasible it is to enter in light of the competition. This includes identifying key competitors to see who we will be up against. When evaluating a market, it's important to look closely at factors such as how concentrated the market is, what barriers exist that might make entry difficult, and how competitors are pricing and differentiating their products or services. Porter's 5 Forces framework is a useful tool here, helping us understand the intensity of competition, the power suppliers and customers hold, the threat of substitute products, and the risk new entrants may pose. Next, companies need to honestly assess their own strengths and capabilities to ensure they are prepared for success. This means considering financial resources, brand strength, distribution networks, technological know-how, management experience, and how well the organization can adapt culturally. Aligning opportunities with these core strengths helps avoid costly capability gaps. Choosing how to enter the market is a critical decision, with options ranging from exporting, licensing, strategic alliances, or joint ventures, to acquisitions and building new facilities from scratch. Each mode requires balancing control, risk, speed, flexibility, and investment. Timing and commitment also matter. Deciding whether to be a first mover, a fast follower, or to enter later can influence competitive advantage and costs, as can the choice between pilot projects or full launches. Lastly, success depends on careful implementation and ongoing monitoring to ensure the strategy is working and to make adjustments when necessary. Key activities in entering a new market include establishing local operations or forming partnerships to gain market insights and support. It's important to adapt products and marketing strategies to suit local tastes and preferences, while also managing cultural and regulatory differences to ensure compliance and acceptance. Monitoring key performance indicators regularly allows companies to adjust their strategies as needed for better results. For example, Starbucks expanded internationally using joint ventures and licensing, especially in China, where gradual scaling and adapting to local preferences helped achieve long-term success. Netflix took a phased approach, initially targeting select markets, then ramping up quickly by leveraging its digital platform and data analytics to tailor content and reduce physical costs. Conversely, Walmart's expansion into Germany faced challenges due to cultural misalignment and regulatory hurdles, ultimately causing withdrawal. Indian IT firms often start with export-based entry and project offices to build capabilities gradually before setting up fully owned subsidiaries abroad, balancing growth with risk management. Using a structured market entry framework supports clear decision-making by providing a logical process to evaluate opportunities and risks, while also helping reduce strategic bias in planning and execution. Adopting a structured market entry framework helps businesses make decisions based on solid evidence rather than relying solely on overconfidence or intuition. This approach offers scalability, allowing companies to apply it both when expanding domestically and entering international markets. It also promotes better coordination by aligning the efforts of strategy, finance, operations, and marketing within a unified framework, ensuring everyone works toward the same goals. However, there are some challenges to consider. Accessing accurate market data can be difficult and expensive, especially in emerging markets. Conducting thorough analyses can also slow down decision-making, which is a drawback in fast-changing industries. Moreover, rapid shifts in technology or regulations may quickly make initial evaluations outdated. There is also a risk that a rigid, standardized process could stifle creativity and limit bold innovation. In today's digital world, market entry strategies increasingly include digital channels and platform strategies, ecosystem partnerships, regulatory and data privacy concerns, as well as sustainability and ESG factors, all of which are crucial for staying competitive and responsible in modern business environments. Markets today are more connected and competitive than ever, so this framework isn't a strict checklist but rather a guide to help make thoughtful and flexible decisions. It's an important tool for organizations looking to grow responsibly and stay competitive. By carefully analyzing market appeal, understanding competitors, evaluating internal strengths, and choosing the right way to enter, businesses can lower risks and boost their chances of success. Although the framework isn't perfect and can face challenges in rapidly changing environments, it's still very useful when combined with good managerial insight. In a world where growth often relies on entering new markets effectively, companies that use a clear and disciplined strategy are better positioned to build lasting value and maintain a competitive edge over time.